Good day, and welcome to today's in-depth global markets outlook. Thursday's session represents one of the most policy-dense and market-sensitive days of the week, with major decisions and guidance from the Bank of England and the European Central Bank, alongside key economic data from the United States and policy signals from Canada and Australia. This is a day defined not by speculation, but by confirmation of where global monetary policy stands, how close major economies are to a turning point, and how markets should position for the months ahead. This is a day defined not by speculation, but by confirmation of where global monetary policy stands, how close major economies are to a turning point, and how markets should position for the months ahead. Let's begin with the broader macro backdrop before moving into the regional breakdown. Global context. Markets at a policy inflection point. Financial markets are currently operating at a critical juncture. Inflation across major economies has moderated from its peaks, but remains uneven. Growth is slowing, yet labor markets, particularly in the US and UK, continue to show resilience. Central banks now face a delicate balancing act, maintaining credibility on inflation while avoiding unnecessary economic contraction. Today's events provide direct insight into how policymakers view this balance. Europe. Early signals from demand and industry. The European session begins with Eurozone factory orders and retail sales, offering an early read on both industrial momentum and consumer demand. Factory orders, both year-on-year and month-on-month, are expected to reflect continued weakness. A negative reading would confirm that higher financing costs and softer global demand are still weighing on manufacturing activity across the region. Retail sales data adds another critical layer. Year-on-year growth is expected to slow, while month-on-month figures remain subdued. Together, these releases will help answer a key question. Is the Eurozone economy merely stagnating or gradually stabilizing? Weak data would reinforce expectations that the ECB will eventually need to shift toward a more accommodative stance. Any upside surprise, however, could challenge near-term rate cut assumptions, even if only temporarily. United Kingdom. The main policy event, the spotlight then turns decisively to the United Kingdom, where the Bank of England delivers its interest rate decision, accompanied by minutes, the Monetary Policy Report, and the MPC voting breakdown. The policy rate is expected to remain unchanged at 3.75%, signaling continuity rather than action. However, markets are far more focused on the vote split and forward guidance than the decision itself. If the number of members voting for a rate cut increases, it would signal that internal confidence is growing that inflation risks are easing. Conversely, a persistent split, especially if hawkish votes remain, would suggest the bank remains cautious about declaring victory over inflation. The Monetary Policy Report will be scrutinized for changes in inflation forecasts, wage assumptions, and growth projections. Any downward revision to inflation expectations would strengthen the case for future easing. Later, Governor Andrew Bailey's speech will provide critical context. His tone, whether balanced, cautious, or subtly dovish, will heavily influence sterling, UK bond yields, and equity sentiment. For UK markets, today is not about immediate change, but about timing and confidence. Eurozone, ECB decision and press conference. Shortly after the BOE, attention shifts back to Europe for the European Central Bank's policy decision. The ECB is expected to leave both the main refinancing rate and the deposit facility rate unchanged, reinforcing its data-dependent stance. The real market impact will come from the ECB's monetary policy statement and press conference. Investors will listen closely for any acknowledgement that restrictive policy is beginning to weigh too heavily on growth, especially given weakening credit demand and slowing consumption. If President Lagarde emphasizes caution and patience, markets may interpret this as a signal that rate cuts are not imminent. However, any reference to downside growth risks or improving inflation dynamics could be read as laying the groundwork for future easing. The ECB press conference remains one of the most powerful volatility drivers in European markets, influencing not just the euro, but global risk sentiment. United States, labor market reality check. Across the Atlantic, the U.S. calendar delivers important labor market indicators. First, challenger job cuts for January provide insight into corporate layoff trends. Elevated job cuts would suggest that companies are beginning to respond more aggressively to tighter financial conditions. Later, initial jobless claims offer a near real-time snapshot of labor market health. Claims are expected around 212,000, slightly above the previous 209,000 reading. While still historically low, a sustained upward trend would support the view that labor market tightness is easing, something the Federal Reserve has been monitoring closely. Additionally, Fed President Bostic's speech will be watched for alignment with broader Federal Reserve messaging, particularly around inflation progress and the timing of potential policy adjustments. For U.S. markets, today's data helps determine whether labor resilience is finally softening or simply cooling gradually. Canada and Australia, global policy echoes. Later in the day, global markets hear from Bank of Canada, Governor Tiff Macklem, and RBA Governor Michelle Bullock. While no policy decisions are expected, these speeches matter for global coordination. Markets will assess whether Canadian and Australian policymakers echo the cautious tone seen elsewhere, or highlight regional divergences in inflation and growth dynamics. Consistency across central banks would reinforce market confidence in a synchronized global policy cycle. Divergence, however, could introduce renewed volatility in currency and bond markets. Market expectations and scenarios. Taken together, today's events present three broad scenarios. Scenario 1. Gradual normalization. Data weakens modestly. Central banks maintain restrictive policy but acknowledge progress. Markets price in gradual easing later in the year, supporting equities and bonds. Scenario 2. Higher for longer. Policymakers emphasize inflation risks, labor markets remain tight, and rate cut expectations are pushed further out. This supports currencies and weighs on risk assets. Scenario 3. Policy pivot signals. Subtle shifts in language suggest easing is closer than expected. Volatility increases as markets reposition rapidly. At present, markets appear aligned with the first scenario, but today's guidance will test that assumption. Closing perspective. To summarize today's outlook, Europe tests demand through factory orders and retail sales. The Bank of England clarifies internal policy direction. The ECB reinforces, or subtly reshapes, its policy stance. U.S. labor data gauges the effectiveness of monetary tightening. Global central bank speeches add context and alignment. This is a day where language matters as much as numbers. Markets are not looking for dramatic moves, but for confidence, consistency, and clarity. That concludes today's Deep Global Markets Outlook for Thursday, February 5. Thank you for watching, and we'll continue to track how policy decisions and economic data shape the global financial landscape.